Hello, this is Dani Beit-Or from Simply Do It, and I want to take a few minutes to go over our rental property analysis Excel and explain to you how to use it, how to benefit from it. It's important to understand all the different features that we have. I'm actually quite excited because this is our um, 30th version. We just decided to call it version 3, and we keep improving it and adding to it so we can make the most out of it. So there's quite few improvements to make it a little to make it more beneficial for us investors when we are analyzing rental properties. I'm going to go over the Excel and explain to you how to use it and go for the different tabs. I just want you to know that we have 3 versions. We have the basic version, the plus version, and the premium version. And you can see at the screen here what's the cost for each version and what features are included in each version as well. We have been using this Excel for, I want to say 5-6 years at least, maybe about 5 years or so, maybe just about that. And we keep tweaking it and improving it. And the main need for that Excel was on my end as an investor. I never felt that there is a good tool for me to use quickly and evaluate rental properties accurately. Most importantly is accurately. I should say that the general mindset for this Excel is that it's a realistic case scenario. And that's how we approach it. It's not a best case scenario. It's not a worst case scenario. It's a realistic case scenario. When we analyze properties based on the realistic case scenario, we tend to be very close to reality. That's the whole point, what we're trying to do. And this is how I would suggest for you to approach the analysis itself, and actually think about the realistic case, not worst case or best case, of course. I want to start before we dive into everything that we have here, and I'm going to use the premium feature so we can go over everything. I want to spend just a quick few minutes, a minute or two, to explain the basic understanding of this Excel. So the whole point behind it, in terms of the analysis, right? So everything is about the analysis. So the whole point here is actually, in order to calculate the ROI, the total ROI, as you can see over here, is a combination of the cash on cash, the return on equity, and appreciation. That's at least how I believe a true ROI should be calculated. So that means the cash on cash is the actual cash flow that we're getting from a property on a monthly or annual basis. That's very simple. Well, we'll see that in a second, but that's just the simple idea. It's a simple understanding. Appreciation is how much our house is going to appreciate in the next year or years. And how much appreciation to use, it's entirely up to you. I tend to use a very minimal appreciation rate personally, like 4.5%, 5%, which is basically the rate of inflation. Appreciation is tricky. The higher appreciation rate you're going to include in the Excel, the more speculative you are. So it's entirely up to you. But the way I see it is, we got to give it some consideration and not ignore it, completely. And lastly, especially when most of us buy real estate with mortgage, is the return on equity. And return on equity is simply the following understanding. When you buy a house with a mortgage, you borrow, let's just say you borrow $150,000. Your mortgage is, principal is $150,000. Okay, that's just as an example. And when you start paying it off, or maybe you should say when the renter starts paying the rent and the rent covers for the mortgage payment, assuming that's the case here, which is usually how we see it on our end, then you're paying off slowly the principal amount that you borrowed. So that means in a 1 year span, if you pay, let's say you borrow 150,000, let's just use it, for simplicity. Let's just say in the course of the first 2 years, your mortgage principal balance was reduced from 150 to 140. That's $10,000. That's equity is yours. It's still in the house. It's still sitting in walls, but it's your equity, to benefit from. So that means there is a return on the fact that you just added another $10,000 to your house just by paying off the mortgage principal. So the way I see it, the true ROI is the cash on cash, which is the actual cash flow, the return on equity, paying down the mortgage, and some appreciation. It could be a very minimal one, but it still needs to be factored. While we are on this page here, I just want to show you that we have some, this is the general notes. We have some explanation and general comments on a few things. So you can always refer to this page if you're not sure about some of the terminology throughout the Excel itself. Now, the Excel, as you can see, it has multiple colors and sections. First, we have multiple tabs. You got the About, which is just about the Excel. The Start Here, obviously, this is where we want to start and plug in the numbers. The Analysis. We got a Compare, which is a new feature. I'm going to go over it. We can have a Brochure. A brochure is something that we can just print a property and present it to someone else. We have a Mortgage amortization tab, a Sales Analysis, General Note, and we also have the Analysis Engine. The Analysis Engine is really where we calculate everything in the background in order to produce those all those formulas. So let's just go one by one and start with the Start Here tab. A lot of the tabs you will see have a little red triangle, which means there's notes, so you can actually refer to the notes in order to understand exactly how to put the information. The green background, the light green background, is where you want to plug in the information, which is probably going to be different from one property to another. And the yellow is the recommended. You can override it, but this is, this is the recommended settings. So you can always override them if you want. So we start with section 1 on page, on tab Start Here, and we plug in the property information. We change the schools rating from a 1 through 10 to an A, B, C, D method. It's just easier to kind of address it. You can then go into the purchase section 2, purchase assumption, plug in the purchase price or how much you're considering paying for this property. And this is what the market value of that property. If we have any improvements to the house, say we need to paint it or do some maintenance, we're going to plug it here. What are the closing costs that are estimated? What are the mortgage costs estimated? And if we have any additional fees that we need to factor in. In section number 3, we're going to have the financing assumptions, the down payment, and then it calculates, of course, the interest rate, 30 years or less or more. In this section, if you're using cash, you probably want to put 100% down. And because this Excel doesn't like zeros many times, I like to just use 9.9, practically 100%. I'm just using 99.9, and in the interest rate, I'm going to use 0.001, and it just pretty much makes it, zero interest and zero, 100% down purchase. I'm just using it because Excel, sometimes when you plug in zeros, it doesn't calculate things properly sometimes. Let's just go back to that. Then we have the section of the what is the rent, the property taxes, the percentage of the property tax, the actual property taxes, insurance, repairs, property management, I will explain that in a second, leasing fee, a homeowner association, and what do we consider as a vacancy rate. Now, what we added in this version is actually we added a column here to calculate those items annually. I think this was missing. And the other things that we did is sometimes we have property managers that are charging a fixed rate, a flat rate, let's just say a flat monthly rate, and many times we have a percentage. If you have a property management that is charging you, let's say $100 a month, you just plug in $100 and the formula knows to use the $100. However, if this is a percentage and you want to use a percentage, you actually need to put 0 here, and then the formula will take the 8% or 9% or 7.5%, whatever the situation calls for. So plug in the flat rate, and then it won't use a percentage, or plug in 0 and it will take the percentage. Listing fee is obviously the to get the house rented, HOA if we have, and so on and so forth. So we can have everything. And monthly is where we plug in, and this is where the formulas are calculated. The one thing that I wanted to say here is that I'm not sure what happened. Okay. The one thing that I didn't mention here is this is what we call the cash outlay. Actually, how much did we spend on this property? What is the cost of this property? So it's the down payment, the closing cost, the repairs, all of those. It really adds up the actual out-of-pocket expense, and that's also the base for the ROI calculation. Because anything we want to calculate, we want to calculate based on what we actually spend. Now, I'm going to move, now that we plug in the numbers, we're going to move into the analysis summary. In this case, I just want to show you that we have the information from the previous tab all over again. It's just copying. You don't have to plug in. You have it, so you have it in front of you. And here we have two sections that I think that are very, in my opinion, are very important. It's section A, B, and D. Now, A is where we have the analysis, what we call the financial analysis, deal attractiveness. Now, what I want you to see here is that we analyze the property, or the Excel analyzes the property performance in 5 years, 10 years, 15, and 20. And then it does averages for these periods of time, so we can actually not look at the property, how is it performing on the first day, or the first month or the first year, but actually what's the average performance of this property in the first 5 years, the first 10 years, etc. Okay, and the two key parameters I'm looking at is what is the average cash flow per month, right? Average cash flow per month in the first 5 years, and the annual ROI per year in the first 5 years. And you can see those numbers do change because we do make an assumption that the rents do tend to go up. Okay, we have this is how we look at the deal analysis and attractiveness. The other thing that I have here that I want you to look at is, I think, very, very important, section D. Section D is a location where we can actually plug in our own criteria. So this is my criteria. And let's just say, as an example, we're looking for at least C+ schools. The house needs to be 1250, 3 bedrooms, 2 bathrooms, 1990 and after. Rent purchase price let's just use 0.85, or let's just use 1%. Average cash flow $100, and average ROI 15%. So this is what my minimal requirements would be as my baseline. Every property that I look at, I want to compare it to my baseline. So this property, you don't have to do much. It's already plugged, taking it from other cells in the Excel. This property is a B schools. It passes. It's a 2,500 feet, square footage. It passed the, my minimal requirements. 3 bedroom, 2 bathroom, 2009. 1% is what we get. Rent purchase price ratio. Average cash flow is 246. We pass, and ROI is much higher than 15%. So in this case, you can see that this property passes with flying colors. Okay. However, let's just say I'm looking for 350 a month. I'm looking for 1.3%, and I want the 4 bedrooms, and it's got to be A schools, right? So in this example, if I change my criteria, you can see that this house doesn't pass with a flying color. Okay. Also, what I want you to understand is that we use the benchmark criteria, this rating, as something that we can compare. So that means, for example, let's just go back to all past, and let's just say we're looking for $300 a month in cash flow, and we're looking for 2010. Okay. Now this house is black and white. It's failing my criteria. However, if you exercise some judgment, you will see that it's only failing by 1 year, probably not something you would want to rule out, and it's only failing by $50. So in that case, I would probably not be too concerned about this failing and would exercise some judgment, but at least I want to be able to eliminate the bad properties altogether and not waste any valuable time over them. So I can see this property matches or just about my criteria or it doesn't. So it's a very important section to use in order to analyze properties in the best possible way. Now, in this version, we added a little feature that we call it compare properties. Compare properties is another tab. It's not available in all the versions. It's only available in the Premium and Plus. But the whole point is to take all the analysis information and put it in a form that it's side by side. So that means if we're gonna look at this property and we're gonna click on, we have a little button here, over here, and we have the same button over here, right up here. Okay, so let's just go back. It does exactly the same thing. I'm gonna click on it. There's a little macro, a little a script running in the background, and the only thing it does, it gathers all that information from the Excel and just aligns it in a different format, a side by side. And the side by side is going to help you compare multiple properties and maybe even keep track of the different properties that you consider or evaluated. And it can go on as much as you need. So this is something you wanna I think it's very neat. It's very important to have for investors. And just by clicking that little button of compare properties, by the way, you need to enable the macro feature on the Excel in order to make it work. Otherwise, it just wouldn't work. Okay, so we have the compare. The brochure is something that you can just, all the information of this property except the photo populates over here in a more clean format, so you can print it if you want to or send it. We have the mortgage amortization schedule. I'm not going to go over it. It's very straightforward. In I think only the premium version, we have what's called the sales analysis. So we made a sales analysis, and you want to see how this property is going to perform with all the assumptions of taxes and and depreciation and depreciation recapture and all those things. Of course, with the general assumptions, how this property is going to perform. We don't factor the fact that you may do a 1031 exchange or just outright sell it. What's going to be the net return, okay, and cash flow or cash if you sell that property in every single year. So you can see we go all the way to 30 years and we're analyzing this property over the course of that time. So you can, in any given year, you can say, okay, in year number 10, this is what my gains should be, net gains, and this is the net return I should be looking at. Okay, so of course it makes general assumptions in the start here about the tax rate, the tax bracket, and all of those, so you can overwrite them over here. So if you go to the start here tab, there's some assumptions you can overwrite, such as what is the average rent increase, on average, or what is the commission when you sell the property. We use 7.5 because many times it's 6% sales commission and another point, a 1.5% for other sales expenses, and so on and so forth. You can definitely overwrite that information, and you can see that the sales analysis, it's 7.5%. It's exactly the same 7.5%, and you can always override it. Already talked about the general notes that we have here, and the one thing that we also, kind of worth mentioning, this is what we call the analysis engine. We take the property and we, instead of analyzing on the first year performance or in first months or anything like that, we just go and stretch all those assumptions, everything, over the course of 30 years. And we're doing an analysis on every single year, all those parameters that I told you about. And only when we have it stretched over 30 years, then we can actually do the periodic averages of the property, per 5, 10, 15, and 20 years. So it gives you an indication of the property and its performance. So basically, the way we see it, this is not an analysis Excel. It's more like a business plan for the property, and every property has its own business plan. Now, I got to tell you something. On a personal note, I have used this Excel, combined in all its earlier versions. Um, I want to say well over 1,500 times. I want to say even well over 2,000. So that means every property that I look at, and I look at many properties on a daily basis, and I'm considering, purchasing or analyzing it, I open the Excel and I plug in the numbers, right? I don't go and make any offers, or I don't go and do any investments without using this Excel. I may make an offer and then go back to the Excel, but I always use the Excel. I feel completely mute and not well prepared if I'm not using this Excel to analyze the properties. If you don't have an Excel, use this one. If you have an Excel or something else, that's fine too, but at least you have a tool that helps you make those decisions. So with that said, if you have any questions, you can let us know. And this is how you can use and benefit the Simply Do It real estate rental, property rental analysis Excel. Thank you very much for taking the time. I hope you will benefit from this and find it easy to use. It's very important, and I hope you find it easy to use. Thank you.